Assalamu alaikum. A very good day to you all. And at first, I would like to provide all types of praise for the Almighty Allah who has given me a chance to join such like our digital platform. And dear learners, and who are now in front of myself. And here, I am Muhammad Mahbub Hussain. Presently, I am working as a lecturer of accounting. My working station is now Government Hussain Sarwati College, Magura. And today, I gonna take a session on financial management. And here, the respective topic is evaluate the acceptability of an investment project using the internal rate of return method. Typical budgeting decision. Capital budgeting tends to fall into two broad categories. Number one, screening decisions. Does a proposed project meet some project standard of acceptance? And number two, the preference of decisions selecting from the among several competing courses of action. Today's the learning objective is that evaluate the acceptability of an investment project using the internal rate of return method. Internal rate of return method describes that internal rate of return, that means IRR, is the rate of return promised by an investment project over its useful life. It computed by finding the discount rate that will cause the net present value of a project to be zero. It works very well if a project's cash flows are identical every year. If the annual cash flows are not identical, then a trial and error process must be used to find out the internal rate of return. So the prescribed general rules are as follows. If the internal rate of return is equal or greater than the minimum rate of return, then the project will be accepted. In case of less than the minimum required rate of return, then the project will be rejected. That means if the internal rate of return is less than the minimum required rate of return, then the project will be rejected. So, when using the internal rate of return, the cost of capital acts as a 100, that means barrier rate that a project must clear for acceptance. So, here the sample math. It is time to calculate a sample math so that we may understand very clearly what are the particular relation with the theory. So, a drug company can purchase a new machine at a cost of $104,320 that will save $20,000 per year in cash operating costs. So, here the machine has a 10 years life. The expected estimated life cycle is 10 years. Internal rate of return, in this case, the future cash flows are the same every year in this example. So, we can calculate the internal rate of return as follows, very easily. Present value factor for the internal rate of return equal to investment required divided annual net cash flows. So, here the given amount, investment required amount is $104,320 and annual net cash flows is given $20,000. So, the ultimate result is 5.216. By using the present value of an annuity of one table, find the 10 periods row, move across until you find the factors 3.216. That means by calculating present value factors at 14%, At the end of 10 years, the accumulated present value factors are with 14%, the result will be 3.216. That means by present value factors at 10% at the end of for 10 years 6.145. By using 12% we will get 5.650, and by using 14% present value factors at the end of 10 years we will get 5.261. So as the figure here 3.216. So let's go to the next slide for better understanding. Present value factors at 10% for first year 0.909, second year 0.826, third year 0.751, fourth year 0.683, and fifth year 0.620, and sixth year 0.564, seventh year 0.513, eighth year 0.467, in the year 9 0.683, and in the year 10 0.386, and at the end of 10th year the accumulated cumulative figure present value factors at 10% will get 6.145. Similarly, at 12% we will get for first year, second year, third year, fourth year, fifth year, sixth year, in the sixth year, seventh year, eighth year, in the year 9, in the year 10, and ultimately the cumulative present value factors at 12% will get 5.650. So in 14%, in first year, second year, third year, fourth year, fifth year, sixth year, 7, 8, 9, and 10. And at the end of the 10 year, the cumulative figure will be, cumulative present value factors at 14% will get 5.216. So, Darker company can purchase a new machine at a cost of $104,320 that will save $20,000 per year in cash operating cost, and its estimated life cycle is 10 years. So internal rate of return on 14%, this project is 14%. The internal rate of return on this project is 14%. If the internal rate of return is equal to or greater than the company required rate of return, the project is accepted. So in this particular cases, the project is accepted. So now it is time to quick test. The expected annual net cash inflows from a project 22 over the next 5 years. The required investment now in the project is $79,310. So what is the internal rate of return on the project? So in what so you have to calculate? It will be 12% because 79,310 divided by cash flow of the cash inflow of the project $22,000 per year. So the result will be 3.605, which is the present value factors for an annuity over 5 years when the interest rate is 12%. So in this case, the table value is required, and by present value factors at 12% in the year of 5, the figure of the cumulative present value factors at 12%, the result will be 3.605. So in this case, 12% is the result. 12% is the required interest rate. Am I right? So comparing the net present value and the internal rate of return methods. In what way you will compare the net present value methods and internal rate of return methods? Net present value methods is often simpler to use. Okay, questionable assumption. Some question may raise in your mind. Internal rate of return methods assume cash inflows are reinvested at the internal rate of return. Actually not. So, expanding the net present value methods. To compare the competing investment project, we can use the following net present value approach by two ways. Number one, by total cost, by incremental cost. So, the total cost approach, White company has two alternatives: remodel an old car wash or remove the old car wash and install a new one. The company use a discount rate of 10%. Then what will be the result? Okay, let's go to the calculation. New car wash and old car wash. Annual revenues in this case 90,000 has given, and case old car wash has given $70,000. Annual cash operating cost 30,000 and respectively for old car wash 25,000. Annual net cash inflow in this case 60,000 and 45,000. Okay, so in the formula of total cost approach, if the White install a new washer, then the respective cost and relevant information is given below. Cost 3 lakh, dollar. Productive life cycle is 10 years. Salvage value is 7 years. Replace as brushes. In this case, at the end of the 6th year, 50,000. Salvage value of an old equipment 40,000. Let's look at the present value of these alternatives. The total cost approach. By using the total cost approach, install the new washer. You have to initial investment. Means now means you know very well in case of net present value methods approach, and now means 1. So our initial investment means it is cash outflow. So we have to calculate 1 multiply with initial investment, that means cash outflow. So 3 lakh. In this case, replacement brushes 6 years. At the end of 6th year, the cumulative present value factors that 10% is 5 point present value factor. At the end of the not cumulative. At the end of the 6th year, the present value factors is 0.564. So you have to multiply with 50,000 with cash outflow. So in this case 28,200 cash outflow. So annual cash inflow 1 to 10 year. In this case cumulative present value factors at 10% is 6.145, and you have to as the cash inflow is 60,000, so the total figure will be $368,700. Salvage value of old equipment now means 1, so 40,000. You have to 40,000 here. The amount will be 40,000 is cash inflow. Salvage value of the new equipment. Salvage value of the new equipment is also a cash inflow. At the end of 10 year, the 10% present value factors at 0.386. So you have to multiply with 7,000. Then the figure will be 2,702. So by sum of the whole figure, we will get 83,000. We will get 83,202. It is the positive figure. Am I right? So net present value in this case is a positive figure. As the net present value is the positive figure, if we install the new washer, the investment will yield a positive net present value of 83,202. So this project will be accepted. This project will be accepted as the net present value is the positive figure by sum of cash outflow and cash inflow. Okay, the total cost is going on in this moment. If the White remodels the existing washer, remodel cost is 175,000. Replace brushes at the end of 6th year 80,000. Remodel cost 175,000. Replace brushes at the end of 6th year 80,000. So let's now look at the present value of this second alternative. Remodel of the washer. Initial investment here. Initial investment in this case 175,000. That means cash outflow as now means 1. So initial present value in this case 175,000 and replace brushes 6 year. That means the present value factors at the end of 6 year 0.655 564. So the figure will be 45,120. In this case, 1 to 10, the cumulative figure present value at 10% at the end of the 10th year, 6.145. So annual cash inflow here in this case for old washer 45,000. So the figure will be present value 276,525. And by sum up, by calculating or sum up cash inflow and outflow, we will get the positive figure in this also. In this case, net present value 56,404. That means by two alternatives we have already computed the positive figure. From previous we have got 83,202. From the first alternative, it is also the positive figure for net present value, and in this case 56,405, it is also the positive figure. So if with the models some existing washer, we will produce a positive figure. So in this case, it is also be accepted. It will also be accepted project. So the total cost approach, both projects yield a positive net present value. So first one we have got 83,202, and from second alternatives we have got 56,404, and in the favor of new washer we have got 26,779. However, the existing in the new washer will produce a higher net present value than the remodeling old washer. So we have to accept from the two alternatives. First one, that means the new washer, and we should invest in new washer. Am I right? So it is time to understand the theme song of this map. Under the incremental cost of this approach, only those cash flows that differ between the two alternatives are considered. Let's look at an analysis of white company decisions using the incremental cost approach. Incremental investment now means 125,000. 1 is now means 1, so 125,000. Incremental cost versus 6,000, that means 30,000. So the present value factors 19% is 0.564, so 16,920. And incremental cash inflows in this case at the end of the 10th year, cumulative cash inflows 6.145, and here 15,000 cash inflows, so the total figure will be 92,175 of the present value. And now means here 1, so 40,000 cash inflow, so cash inflow will be 40,000 for salvage value of the equipment. Salvage value of the new equipment also be 2,702. So the total figure by sum of 26,779, we get the same answer under either the total cost or incremental cost approach. That means by this system, incremental cost system and total cost system will give the same figure. Okay. Now it is time to quick test, and so that we may understand clearly which project we should accept. Consider the following alternatives project. Each project would last for 5 years. That means the useful life in this case for both project A and B is 5 years. Initial investment, that means cash outflow for A 80,000 and for B 60,000. Annual net cash inflow 20,000 for A and 16,000 for B. And in this case, the salvage value 10,000 and 80,000. It is also considered will be cash inflow. So the company uses a discount rate of 14% to evaluate the project. How 14% discount rate to evaluate the project. Now the question to you: which of the following statement is true? NPV of the project A greater than NPV of project B by $5,230, or B project is greater than NPV of the project A by 5,230, or A project is greater than NPV of the project B by $2,000, and in case of B is greater than NPV of the project by A, $2,000. Which one will be the right answer? So let's calculate the respective figures, then we'll understand very clearly. Okay, in this case, B is the answer. In this case, B is the answer. NPV of the project B is greater than NPV, net present value of the project A, by 5,230. That means B figure, that means B projects will be bigger. B projects will be bigger. Now we have to calculate. Okay, here look, now means here, now means 1. How much amount? 20,000. 20,000 means 80,000 minus 60,000 equal to 20,000. 80,000 minus 60,000 equal to 20,000. It is the initial investment. That means it is cash outflow. Okay, now means 1. Now means 1. So 120,000. 1 to 5 years. As it is the cash inflow at the end of the 5 years. How much amount? 20,000 minus 60,000. How much amount? 4,000. 4,000. Okay. So 4,000. 4,000 at the end of 5 years at 14 present value factors 4%. The cumulative present value factors 4% will be 3.433. 3.433. Cumulative present value factors at 14%. 3.433. So $13,732. Salvage value. Salvage value means cash inflow. Am I right? So 5. At the end of the 5 years, the present value factors at 14% of 5.19. And salvage value in this case 10,000 minus 8,000 equal to 2,000. 10,000 minus 8,000 2,000. So what will be the figure? 0.519. So in this case, the present value will be $1,038. So by sum up, we will get 5,233. As here, cash outflow is the bigger. Cash outflow is the bigger. That means the negative sign. Am I right? Negative sign means cash outflow. So in this case, cash outflow is bigger than the B. Then B is bigger than A. B is bigger than A. So in this case, NPV, net present value of the project B, is bigger net present value of the project by A. By how much amount? $5,230. $5,230. So it is very easy for you to understand when you will calculate this method by this way. So I will suggest my beloved ones to subscribe my YouTube channel so that you may get promptly my upcoming videos.